Let's start at the very beginning. We're going to break down a crucial concept for anyone venturing into the world of business, whether you're just starting out or looking to solidify your existing operations. A limited liability company, or LLC, is a specific type of business structure recognized by states. It's a popular choice, and for good reason. It's a business structure that protects your personal assets. Think of it as a legal shield between your business and your personal wealth, like your house, the place where you and your family live, and car, your means of transportation and a valuable asset, from business debts and lawsuits. This is a critical distinction. Without an LLC, your personal assets could be at risk if your business incurs debt or faces legal action. It combines the legal protection of a corporation offering a similar level of security, with the simplicity and tax flexibility, making it more accessible for smaller businesses. Of a sole proprietorship or partnership, it offers the best of both worlds, providing a balance between protection and ease of management. If you're starting a business, taking that leap of faith and building something from the ground up. Whether you're a freelancer, offering your skills and services independently, a tradesperson providing essential services in your community, or opening a shop, creating a physical space for customers to interact with your brand. An LLC can be your best friend. It's a foundational step towards securing your future and minimizing risk. It establishes your business, giving it a formal and recognized structure as a separate legal entity distinct from you as an individual. So, if someone sues your business due to a product malfunction or service dispute, they're suing the company, not you personally. Your personal savings, investments, and other assets remain protected. This separation is crucial, providing peace of mind and financial security for protecting your personal assets. It's a safety net that can prevent a business setback from becoming a personal financial disaster. How you pay yourself from your LLC, whether it's through salary or owner's draw, isn't just about moving money. It's a strategic decision with far-reaching implications. It affects your taxes, potentially increasing or decreasing your tax burden, paperwork, creating more or less administrative burden, and legal protection. It's all interconnected, and understanding these nuances is key. Getting this wrong, misunderstanding the rules and regulations, can lead to overpaying taxes, unnecessarily reducing your profits, or even losing your liability shield. Exposing your personal assets to business risks. Understanding your payment options and the implications of each is a fundamental part of running your LLC, ensuring its long-term health and stability, properly and strategically, setting you up for success in the long run. Choosing how to take money out of your LLC is one of the most important financial decisions you'll make. Your pay method directly impacts your taxes and the legal protection of your LLC. Treating your business account like a personal piggy bank can risk your liability protection. Paying yourself through a formal, well-documented method, salary or draw, reinforces the separation between you and your business. A regular salary can make budgeting and applying for loans easier, while an owner's draw offers flexibility but may require more documentation. Your choice also affects retirement planning. A salary allows for contributions to retirement accounts. Getting this right from the start builds good financial habits and keeps your business healthy. Rushing or ignoring this decision can lead to messy bookkeeping and surprise tax bills. Take the time to understand your options now. It's an investment in your business's long-term health. The structure of your LLC, single-member or multi-member, determines how you get paid. In a single-member LLC, the IRS treats you and your business as one for tax purposes. You can't pay yourself a salary. Instead, you take an owner's draw, transferring profits from the business to your personal account. You're taxed on all business profits, not just what you draw. In a multi-member LLC, profits and losses pass through to each member's personal tax return. Members take draws or distributions, divided according to the operating agreement. The operating agreement should clearly define how profits are split, by ownership percentage or another method. Each member is taxed on their share of profits, regardless of how much they actually withdraw. Clear agreements and records are essential to avoid disputes. The right setup keeps everyone on the same page, and it keeps your LLC compliant and protected. There's a powerful exception to the no salary rule, electing S-Corporation tax status for your LLC. With S-Corp status, you must pay yourself a reasonable salary as an employee. Research what's reasonable for your role and document it. This is critical for IRS compliance. Set up a payroll system to withhold and remit taxes from your paycheck. You'll receive a W-2 at year's end, just like any employee. After your salary, remaining profits can be taken as distributions, which aren't subject to self-employment tax. This split, salary plus distributions, can mean significant tax savings. Payroll services like Gusto or QuickBooks can help you stay compliant. The S-Corp election doesn't change your LLC's legal structure, just how you're taxed. You pay payroll taxes on your salary, but not on distributions. This strategy can lower your overall tax bill, but it comes with more rules and paperwork. For LLCs not taxed as S-Corp, the owner's draw is the standard way to pay yourself. It's as simple as transferring profits from your business account to your personal account. No payroll, no tax withholding at the time of the draw. Always ensure your business has enough profit and cash flow before taking a draw. Record every draw in your accounting books as an owner's draw or member distribution, not a business expense. Draws aren't tax deductible for the business. You're taxed on the entire net profit of the business, not just what you withdraw. For example, if your LLC earns £80,000, but you only draw £50,000, you still pay tax on the full £80,000. Set aside money from your draws for estimated quarterly tax payments. Good record keeping is essential for tax time and financial planning. Understanding the tax implications of how you pay yourself is absolutely critical for any business owner. It's not just about taking money out of your business, it's about doing it in a way that keeps you on the right side of the law and minimizes your tax burden. We're going to walk through some key considerations to help you navigate this complex landscape. Of your payment method, whether it's an owner's draw or a salary, is the first step. Each method has distinct tax consequences that you need to be aware of. Choosing the right method can significantly impact your tax liability and overall financial health. Tax compliance is non-negotiable. Ignoring or misunderstanding tax laws can lead to serious penalties, audits, and even legal trouble. It's a fundamental aspect of running a business that you simply cannot afford to overlook. With an owner's draw, you don't withhold taxes up front, which might seem appealing at first. But you must pay income and self-employment tax on all business profits at the end of the year. This means setting aside a significant portion of your earnings to cover these taxes. Failing to do so can result in a hefty tax bill and potential penalties. Therefore, make estimated quarterly tax payments to the IRS. This helps you avoid a large tax bill at the end of the year and potential underpayment penalties. Think of it as paying your taxes in installments throughout the year. This disciplined approach is crucial to avoid penalties. Penalties can quickly add up and eat into your profits, so staying on top of your quarterly payments is essential. Keep business and personal finances separate. It's a fundamental principle of good business practice. Commingling funds can destroy your liability protection, making you personally liable for business debts and lawsuits. Maintaining distinct accounts is a critical step in protecting your personal assets. Your operating agreement should outline draw rules, specifying how and when owners can take money out of the business. This is especially important for multi-member LLCs, where clear guidelines prevent disputes and ensure fair treatment among partners. A well-defined operating agreement is the cornerstone of a successful partnership. Never take more than your business's equity. Taking excessive draws can jeopardize the financial stability of your company. It can create tax complications, potentially leading to audits and penalties. Always ensure that your draws are proportionate to your equity and the overall financial health of your business. For S-Corp, your salary is subject to payroll taxes. It's treated like any other employee's wages. This includes both employee and employer portions of Social Security and Medicare taxes. Understanding these obligations is crucial for accurate payroll processing. File quarterly payroll tax reports and annual unemployment tax reports accurately and on time. These filings are essential for demonstrating compliance with federal and state tax laws. Only profits above your reasonable salary can be taken as distributions, which are taxed differently than salary. These distributions aren't subject to self-employment tax, offering a potential tax-saving strategy. However, it's crucial to understand the rules and limitations surrounding distributions. The IRS requires your salary to be reasonable. It must reflect the fair market value of the services you provide to the company. Paying yourself too little is a red flag, as it suggests you're trying to avoid payroll taxes. This can trigger an audit and potentially lead to penalties. Document how you set your salary, including the factors you considered, such as industry standards, your experience, and the company's financial performance. And use a payroll service to stay compliant with ever-changing tax laws and regulations. A payroll service can automate tax calculations, filings, and payments, reducing the risk of errors and penalties. Proper bookkeeping and compliance keep your LLC protected and your taxes in check, ensuring the long-term success and sustainability of your business. By staying informed and proactive, you can navigate the complexities of business finances with confidence. When you're running a business, one of the key decisions you'll face is how to compensate yourself. Choosing between a salary and an owner's draw is a trade-off between simplicity and potential tax savings. It's a decision that requires careful consideration of your business structure, financial goals, and personal circumstances. Understanding the nuances of each option is crucial for making the best choice for your specific situation. The owner's draw is simple. It's a direct withdrawal of funds from the business. There's no payroll to process, no tax withholding to manage, offering maximum flexibility in how and when you access your earnings. You can take money out as needed, without the constraints of a fixed payroll schedule. But all profits are subject to self-employment tax, which covers both Social Security and Medicare taxes. This can add up significantly as your business grows and your profits increase. The more you earn, the larger the self-employment tax burden becomes. Furthermore, irregular income from draws can make budgeting and loan applications harder, as lenders and financial institutions prefer a consistent income stream. The salary method, primarily available to S-Corp, offers a different approach. It can potentially save you thousands in taxes by splitting income into salary, which is subject to payroll taxes, and distributions, which are only subject to income tax. Regular paychecks make personal finances easier to manage, providing a steady and predictable income. It also allows for the implementation of employee benefits, such as health insurance and retirement plans, further reducing your overall tax liability. However, running payroll adds complexity and cost, requiring you to manage payroll taxes and filings. Furthermore, you must pay yourself a reasonable salary, as determined by the IRS, even in slow months, regardless of the business's profitability. S-Corp status also means more paperwork and compliance requirements. You'll need to file a separate tax return for the S-Corp, adding to your administrative burden. The right choice ultimately depends on your business's size, its financial stability, and your personal financial needs and preferences. Simplicity and ease of management often favor the draw, while potential tax savings and the desire for predictable income often favor the salary method. Carefully weigh the pros and cons in relation to your specific situation and consult with a tax professional to make an informed decision. And remember, your business needs may change over time, so you can always reevaluate and change your approach as your business evolves and grows. How do you choose? It comes down to your business's profits and your tolerance for complexity. If your net profit is under £40,000, £50,000, stick with the owner's draw for simplicity. As profits grow and stabilize, consider S-Corp status for tax savings. Need a steady paycheck for personal budgeting or loans? Salary might be best. Prefer flexibility? The draw model could suit you better. Consult a CPA or tax advisor. They can run the numbers for your situation. Professional advice now can save you money and stress later. The decision isn't permanent. You can switch as your business grows. Ready to pay yourself? Here's a quick checklist. Open a dedicated business bank account. Never mix personal and business funds. Create an LLC operating agreement that spells out how profits and draws are handled. Decide between the owner's draw or S-Corp salary based on your profits and needs. Keep meticulous records of every payment you take. Make estimated tax payments or set up payroll as required. Schedule a consultation with a tax professional to confirm your plan and stay compliant. These steps set your business up for financial success and peace of mind.